Tipton.
Thank you, Mr. Chairman. I'd like to thank the committee for considering today the Congressional Accountability for Emergency Lending Act. It is crucial that the Federal Reserve have the ability to be able to respond appropriately and in a timely manner to the financial crises. However, it is also important that the Federal Reserve make decisions in response to financial crisis as judiciously and with as much certainty as possible. Legislation being considered before the committee today seeks to provide greater oversight and certainty to the Federal Reserve's response to the financial crisis. In the aftermath of the 2008 financial crisis, it became clear that the rules for Section 13.3 of the Federal Reserve Act emergency lending procedures needed to be adjusted, and Dodd-Frank took on that task. Well, Dodd-Frank instructed the Federal Reserve to develop rules for its emergency lending practices. It did not limit the character and scope of such practices as well as it could have. Today, the Congressional Accountability for Emergency Lending Act better clarifies the emergency lending powers and procedures of the Fed and codifies the Fed's accountability to the American taxpayer. This legislation first makes the pathway to emergency lending more stringent by requiring the Secretary of the Treasury and 2/3 of the members of the Federal Open Market Committee to find that there are unusual and exigent circumstances that pose a threat to the financial stability of the United States to initiate emergency lending to a financial institution. This requirement means more meaningful deliberation for the emergency lending practices are authorized and limits the scope of who is eligible to receive emergency lending in times of crisis. This legislation also institutes congressional oversight to the emergency lending process by requiring both chambers of Congress to ratify the lending actions of the Fed. Importantly, the legislation does not prevent the Federal Reserve from practicing its lender of last resort authority, but it does require that Congress approve of the Fed's emergency lending activity within 30 days of the extension of the loan. If Congress does not approve of the emergency lending activity, then the recipient financial institution will be required to repay the loan in full 30 days after Congress disapproves. This process will create greater accountability to the American taxpayer, who ultimately funds a default of the Federal Reserve. It will also add an additional layer of accountability to the Fed's emergency lending procedures, ensuring that the Fed, in conjunction with the FOMC and the Secretary of the Treasury, has acted judiciously and in the best interests of the American people. Additionally, this legislation imposes limitations in line with the creed of central bankers in times of crisis. Lend freely, but only to solvent institutions, only against sound collateral, and only at penalty rates. By better defining determinations for penalty rates, the bill provides clarity to both the lender and loan recipient about the cost of this kind of lending, and further cements the expectation that these loans are not for institutions that cannot repay them. Perhaps most important, this legislation sets forth a process known in advance for how federal authorities will respond to a financial crisis, bringing codified certainty to an uncertain time. While this legislation does not limit the authority of the Federal Reserve to practice its lender of last resort power, it does institute much-needed congressional oversight and restraint over the practices of the Federal Reserve. In short, H.R. 4302 creates a bright line between conventional monetary policy and emergency credit policies by establishing practices in response to financial crisis that encourage greater judiciousness and are more accountable to the American people. Again, I'd like to thank the Chairman for consideration of this legislation and the markup and encourage my colleagues to support this measure today. I yield back the balance of my time.